ladies and gentlemen. I've been given a very difficult exercise here to deal with tax valuation, global experiences. We normally refer to as valuation for tax purposes, because of valuation and purposes. But the agenda that I'm going to follow here is basically I'm going to do an introduction and put tax valuation into context. Then we'll go into why property tax, and then deal with the legal basis for property tax valuations, then property tax basis, look at mass appraisal approach, look at tax valuation safeguards, and also we cannot talk about valuations without getting into international valuation standards, and then maybe draw some conclusions from that process. The introduction. Let me say, taxes on real estate are imposed in almost every country in the world. So it's not unique to Zimbabwe. Property taxes are global, effectively. Because they are taken as part of a balanced system of taxation, every country looks at that it's incomplete. Your tax system is incomplete unless it includes property tax. However, taxes are a creation of national legislation, and they don't exist in common law. So a government or a country deliberately decides to have a property tax. Property tax generally, or taxes generally, can be classified in two ways. There are general taxes and recurrent taxes. And I'll go into why I'm bringing this classification. In property, the general taxes would relate to your income tax. If you're running a property business where you trade in properties, you attract income tax, capital gains tax, transfer tax, estate duty, value-added tax, but these are not classed as property taxes. The property taxes are what you commonly refer to as the recurrent taxes, which are your rates, and rates is a term normally used in the Commonwealth. Countries of a British colonial heritage use rates, others use assessments and etc. And then there is this interesting phenomena coming in, which is wealth tax, which I would think is a recurrent tax. So taxes are imposed on value of or some surrogate figure applied to units of real estate. This may be on land, or it may be on buildings only, or it can be on land and buildings together. So why recurrent property tax? Property tax is considered an important source of revenue for governments in many jurisdictions globally. And economists believe it is good tax. It is a good tax. They say it does not affect economic growth negatively. However, it is a significant expense to owners and or occupiers of properties, both residential and non-residential. So property tax is a current ad valorem tax. What it means is that ad valorem is just a Latin word which translates to, means according to value of something. So it's a tax according to the value of the property. So in our case, tax is based on the value of taxable properties within the jurisdiction. But however, this demands a relatively high cost and expertise level for it to be implemented. So the World Bank, in a research in Europe and Central Asia region, indicates that there are 4 principal preconditions for introducing value-based recurrent property tax. 1, you need to have a comprehensive property registration. And 2, a reliable source of data about prices achieved in transactions. And 3, a valuation infrastructure that complies with internationally recognized standards. And 4thly, an efficient tax collection system. So, value-based recurrent property tax, our rates, can easily be called a wealth tax. In the current form in Zimbabwe, it's still a wealth tax, in the sense that the benefit, the burden of tax falls on part of the population which possesses assets, or in other words, which have got wealth. However, in our case, there are many asset-rich individuals in Zimbabwe, but cash poor. And taxes are not paid by assets. They are paid by cash. You have to have the cash to pay your taxes. So you could be asset-rich, but if you have no cash, you can't pay your taxes. So what is the legal basis for property tax valuations? All countries that have property tax systems have an enabling legal framework. And the legal framework is legislation and any relevant case law governing the required valuations. But the critical attribute that is needed for a successful property tax system is transparency. Because the value on which the tax bill is based must be clear and understandable. That's the only way you have a system that is successful. Many taxpayers have an idea of the market value of their properties, but most are not familiar with the legal framework that governs the provision of their valuations. And this is what I hope today the other panelists will be able to unpack for you. I will not go into the details of that. So in some countries, for example in China, Botswana, and Lesotho, property taxes are imposed only within urban areas. But in Australia, United Kingdom, and the United States, different states, jurisdictions, and cities within the country may operate different forms of property tax systems. So in a country, you could have in Zimbabwe, for example, you have Bulawayo running its own tax system, property tax system, Harare running its own, Gwero running its own differently. That's the nature of how the taxes are like in other jurisdictions. So the huge variation of property tax imposed in countries around the world makes it very difficult to draw generalizations. However, I'll try to draw some generalizations irrespective. So these variations are driven by differences in socio-political aspirations of a country, perceptions of and traditions relating to land rights, infrastructures, available resources, the history of the country. Like ours is driven directly from the British system because of our colonial history. The needs and the cultures. And this has been derived from the UN Habitat in 2011. So let's look at valuation responsibilities in some selected countries. Who is responsible for valuation? In some countries, commissions or committees are set that are responsible for valuations for property tax purposes. And these are countries like your Cabo Verde, your Cote d'Ivoire, your Egypt, your Sao Tome and Principe, and your Sierra Leone. In others, the central government valuers who do everything, the valuation of those for tax purposes. And this is in Kenya, in Lesotho, in Malawi, in Mauritius, Namibia, Uganda, and Zambia. In other countries, you have municipal valuers being responsible for valuation for property tax purposes. And this is in your Kenya, your Lesotho, your Namibia, in South Africa, in Tanzania, in Uganda, and in Zambia. In South Africa, it started about 2014. Then you look at the private sector being involved. In Botswana, for example, in the Gambia, in Ghana, in Malawi, in Swaziland, South Africa, and Tanzania. You have private sector actively involved in valuing for property tax purposes. Then you have an interesting scenario where in Cabo Verde, in Liberia, and in Rwanda, they actually have self-assessment. You go and declare your property value. and it's assessed for you. Then there are instances where we have central administration offices. For example, the tax office or ZIMRA could be the one determining that. Or you could have an autonomous government agency. If you look, for example, in Canada, you have what they call the British Columbia or BC assessment, which runs all the tax. It's an autonomous government agency. It actually runs all the property tax assessments in British Columbia, which is a province in Canada. So in New Zealand, you've got Quotable Value New Zealand, which does the property tax valuations. You've got Dazo Institute in Colombia, Municipal Property Assessment Corporation, which is also in Ontario in Canada, because they run different tax systems in different provinces. You have your Burundi as a country. They've got an autonomous government agency running or a central administration office running the valuations. Equatorial Guinea is also another example. In the UK, they've got the Valuation Office Agency, which also runs the valuation for property taxation or taxes. So what is the property tax basis that we find throughout the world? Property taxes are generally levied on all types of properties: residential, commercial, industrial, as well as farm properties. Even in Zimbabwe, I could hazard that we also levy property tax on communal land, because communal lands pay development levy, some development fees, which can be easily attributable to be a tax on an annual basis. So the object of valuation varies from country to country. Other countries use land, which is a cadastral parcel. Others use improvements, which are just the buildings. And others use both land and improvements. So objects or properties are taxed based on either monetary value or on a non-monetary value basis. What does that mean? On a monetary value basis, they are taxed on the market value, on an annual rent value, or on the acquisition price. Okay? For example, in the UK, it should be the price that was paid on the 1st of April 1991 is the basis for the assessment of your property tax or council tax. In Wales, it should have been, I think it should be 2003. The price obtaining in 2003 is the one that is used currently. I think they are going through an exercise at the moment to try to review that process. Or it could be non-monetary value. It could be based on the area or volume. And I think Ciro Ferrero will talk about this. Or it could be a fixed formula, where they just say, well, we charge you $200 if you put a house or whatever, we just pay $200 for a house per month, and that's it. In the UK, for example, commercial properties are taxed on the market rent, which is what they refer to as the rateable value. And residential properties are assigned to value bands based on their market price or market value as of the 1st of April 1991. I think we've gone through this, the property tax basis. So let me move fast on that and move in and look at certain property tax basis across certain jurisdictions. Market value, which is the price between a willing buyer and a willing seller in an arm's length transaction. We all know the definition of market value. And the measure used is comparative sales, distributed replacement cost, your income capitalization, which is the standard method. Examples of countries where it's used. In Canada, they use the market value. In the United States, in Australia, in Indonesia, they use market value. In Japan, in the United Kingdom, in Croatia and Turkey, they use that as well. Or there's also site value. This is the price between a willing buyer and a willing seller in an arm's length transaction, but this is land only. And this is comparative sales less the improvements from the total, or you subtract improvements from the total property value to come to a site value, which we also do in Zimbabwe. So you have your Kenya, your New Zealand, your Jamaica in South Africa utilizing this method. Then you have got rental value, where the tax base is actually the rental value, the annual rental value. This is the value in current use of the property, and the measure used is the net rental income for that property. And this is what you find in France, in Morocco, and in India. And then there's unit value, where the size of property is adjusted to reflect location, quality, or other factors. And this is where you use your square meters of land, and the building area is adjusted. So you find this being utilized in Israel, in Poland, Estonia, in Czech Republic, Slovakia, Armenia, and in Russia. And most of these activities happened, especially in Eastern Europe, post the disintegration of the Soviet Union, when they were introducing open market systems into their countries, and they didn't have the capacity to actually undertake your normal valuations. So that's how they got to that. So this has been adopted from Enid Slack in 2001. Basis provided for in legislation in selected countries. So I'm going to provide you a key, and then I'll go into the details. Where you find there's an X, it says the tax basis provided for in legislation and are being utilized in practice. Where there is an O, it refers to tax basis provided for in legislation but not being used in practice. And then there's land and improvements are taxed as separate taxable objects at different rates, which is our split rate taxation, which is what we do in Zimbabwe. You have your land, if you've got a commercial property, the land is taxed separately at a different rate from your improvements. Then you've got the Sierra Leone tax buildings, where buildings are assessed using annual rental value. And also in Tanzania, where buildings are assessed, so they just do the improvements. The buildings are assessed using capital value. I don't know how they derive the capital value of the buildings, excluding the land. So let's look at the countries. In Botswana, they use capital value. In Cameroon, they use area. In Gambia, they use the annual value, which is the rental value. In Ghana, they use improvements only. In Kenya, they use land value. But the legislation provides for land and improvements to be done separately, but they don't practice that. They don't do it in practice. And also annual value. In Lesotho, they use the capital value, which is the market value. In Malawi, is the market value. In Mauritius, market value, and also annual value. And in Mozambique, they use improvements only, and this could be relating to the fact that the land is all owned by the state. You don't own the land. You look at Namibia, the legislation provides for land value, market value, but they currently use land and improvements separately. And it also provides for improvements only, but they don't use that, but they also use area. Nigeria, market value, annual value, area, and in some instances, they apply a flat rate. In Sierra Leone, it's improvements only. South Africa is land value, market value, land and improvements separately. And in Swaziland, it provides for land value, but they don't use it. Market value, they don't use it. They use land and improvements separately. And they also provides for improvements only, which they don't use. Tanzania and Zimbabwe, our legislation provides for land value, to tax on land value, but it's not being practiced. We normally deal with capital value and land and improvements separately, which is what the City of Harare does for commercial properties. And you use area, which is what they do for the residential side the assessments. So let me go into mass appraisal approach. You see, property tax systems require the provision of valuations of all properties within a jurisdiction at a particular date. I think you have seen the revaluations and it is that happens with the city council. So the term that is normally associated with that is mass appraisal, which just describes the valuation process because you are doing the process in mass. You are doing it all at the same time. In some jurisdictions, the process uses statistical methods which are supported by automated valuation models, and this has been found to be more cost-effective. However, there are some specialized properties, like your airports, your vehicle manufacturing plants, your breweries, etc., which are still valued by a single property approach, where people have to visit each and every property to do the valuation. So valuations provide a distribution mechanism for property taxes. So let me look into the safeguards. What are the safeguards? As much as valuers are expected to act professionally and ethically in undertaking valuations, there has to be a way to put safeguards into the process. And the safeguards that are put in property tax valuations is that taxpayers have a right to challenge a property tax valuation at any time. If you don't believe that the valuation that is being used for assessing your tax is correct, you can challenge that valuation. Taxpayers tend to use professional advisors to act on their behalf, and some of the professional advisors are here. So valuation and professional standards are critical during the appeal process. The only way you can dispute a valuation is either the process has not been followed properly, the professional standards have not been followed. So for you to be able to do that, you must also know the valuation and professional standards that apply to that valuation. So that's why we flow into international valuation standards, naturally. Do international valuation standards apply to property tax valuations? Others take the view that they do not apply because property tax valuations are subject to specific legislation within different jurisdictions. However, all valuations of property undertaken for any purpose for that matter are subject to the requirements of the legislation or legal system that operates in a particular country. All valuations. You cannot do your valuations outside the legislative legal system that operates in the particular country. So international valuation standards do apply to property tax valuations, and I'll demonstrate how. International valuation standards are designed to apply to valuations of all types of assets and for any valuation purpose. So the IVS framework, which requires for objectivity and competence on the part of valuers, is directly applicable because there is no way you can do property tax valuations if you are not being objective in the process and if you have got the competence to do the valuation. Otherwise, it will be challenged. The IVS investigations and compliance and reporting apply with some modifications. The critical one being, because valuations are normally undertaken by internal valuers, there may be no need in the scope of work to talk about instructions from the client and etc. So there will be some modifications in the process. IVS basis of value and valuation approaches and methods apply to property tax valuations, whether carried out by an assessing authority or by the private sector valuers. They apply. Before I go to the conclusions, let me give you an indication of the property or the valuation cycles that obtain in various jurisdictions. In British Columbia, which is in Canada, valuations are done annually, and there are very few jurisdictions that are able to do valuations on an annual basis for tax purposes. In British Columbia, in Canada, they do it. In Hong Kong, valuations are done annually for property tax purposes. In Queensland, which is in Australia, but in Queensland, yeah, it is in Australia, and also in Singapore, they do that. In New South Wales, in Australia, they do a 3-year valuation cycle. They do their valuations every 3 years. In Ontario, which is in Canada, they do 4-year cycles. This is a surprise one. In Germany, they haven't done any valuation for the past 60 years. But they still charge property tax. In Ghana, Liberia, your Malawi, your Swaziland, your Tanzania, your Uganda, and in Zambia and South Africa, they do 5-year cycles. So what is the cycle for Zimbabwe? What is the cycle for Zimbabwe?
10 years.
No. What is the cycle for Zimbabwe? 13 years. No. The minimum cycle for Zimbabwe in the legislation is 3 years. But the maximum is 10 years.
Okay.
So the cycle is supposed to be 3 years minimum, but you can extend it to 10 years. I think for obvious reasons, non-availability of valuers, skills, and etc. So let me now get into the conclusions. And these conclusions have been derived from a study carried out by the National Association of Assessing Officers, which is the international body that deals specifically with property tax and property tax valuations. And this is in 2010. They came to the conclusion that an up-to-date ad valorem tax base provides the best system of spreading the tax burden across taxpayers based on their relative wealth in terms of their real estate holdings, and thus maximizing fairness between taxpayers. They also conclude that the tax base should be subject to annual revaluations so that the share of the tax liability between taxpayers is continually adjusted to reflect the relative movement of property prices in the market. So, what do we draw from these conclusions? So, after looking at all those issues, after the drawing up of those conclusions, and after analyzing all the property tax experience of several countries, both developed and developing, there are 6 critical resources required to be available for a tax system, a property tax system, to be efficient and to operate fair. And 1, you need an active, thriving, and mature property market in which all types of taxable real estate are traded, and from which a suitable amount of accurate and reliable transactional data is available for comparison purposes. Secondly, you need a database of property owners on whom the tax can be imposed. And this must be based on a register of land title or cadastral of land ownership. And you also need a system of municipalities or local authorities with staffing and technology resources to both administer the demand for collection and enforcement of the tax liability and to provide the necessary public services efficiently and effectively. After all, the purpose of property tax is for the municipalities or government to spend the money on public services. So that's the whole purpose. So you need a system that is able to collect that money and use the money in public services. You need a body of professional valuers, skilled and experienced in the full range of valuation methodologies and in the valuation of all types of taxable properties from all locations within the jurisdiction in which the tax is imposed. So in our case, the tax is imposed on all residential properties, second homes, or non-principal dwelling homes across the whole country. So we must have capacity to be able to deal with evaluations. And also we must be able to identify, we must have a system that is able to identify which are second homes and which are not. We need a population which recognizes the benefits of the services paid for by their taxes. We must demand the benefits for our taxes, and which therefore is willing to pay as well as engage with their municipality or local authority in genuine debate as to the nature and quality of services provided. Now it's going to hurt because it's now property tax. It's wealth tax. It's going to hurt. So we need to engage the local authorities so that at least there's a genuine debate as to the quality of services that we demand or that should be provided. And finally, we need a government which is responsive to changing circumstances and which ensures that the legislation under which the property tax is imposed is up to date, comprehensive, coherent, and appropriate for the needs of all stakeholders. I rest my case. Thank you.
Thank you.